What makes the stock market move? I don't think there's a better time than right now to be discussing this topic, because in almost every country we have record coronavirus cases per day, record deaths per day, widespread lockdowns, businesses are closing left, right, and center, and people are being laid off. And yet, if you look at the stock market, there's no problem. Look at the S&P TSX composite. It's back to where it was pre-COVID. Look at the US total stock market index. It's actually higher than it was pre-COVID. Pandemic? Don't know her. How is this possible with so much economic hardship going on in the world right now? If you want to know what moves the stock market, what causes stocks to go up and down, and how you can actually change your behavior and possibly even capitalize on these movements, then keep on watching. By the end of this video, you'll be able to answer the question, why is the stock market reaching all-time highs despite everything going on in the world right now with the pandemic? I'm Mrs. Invest. Like this video and subscribe if you're new, and let's get right into the video. The very basics of it is supply and demand. What the stock buyer is willing to pay for the stock and what the stock owner is willing to sell the stock for. If there's more buyers than sellers, then stock prices go up. If there's more sellers than buyers, then stock prices go down. That's pretty simple to understand. But what creates the conditions for there to be more buyers than sellers, or more sellers than buyers? There's two main factors that affect this. Factor number one is factors affecting the entire stock market in general. And factor number two is factors that affect individual stocks, or factors that are stock specific. So let's first talk about factors that affect the entire stock market in general. The first factor that affects the stock market in general is interest rates. Now, interest rates affect how everybody, like banks, institutions, government, investors, how much they're willing to borrow, which in turn affects the economy. When money is cheap, businesses tend to borrow more of it to fund new projects and expansions, and this costs them less money than it did before. And also, consumers like us, we tend to spend a bit more frivolously when interest rates are low, and particularly we tend to borrow more for big ticket items, things that you have to borrow money for because money is cheap, like cars, houses, or funding new business ideas. And when you multiply this by entire countries, businesses, and individuals, that tends to cause the stock market to go up because more money is being spent in the economy in general. And also, when interest rates are low, these other safer investments, think like bonds or GICs, tend to have even worse returns than they used to, and that causes people to pull their money out of these safer investments and put them into the stock market. For example, look at these best GICs right now available in Canada from 1 to 1.7% interest. That's not very good, and so people in search of higher returns will take their money from those investments and tend to put them into the stock market where they can get greater returns. On the other hand, when interest rates rise, people and businesses get a little bit more stingy with borrowing money because it's riskier to do so. Money costs more to borrow. And so that's why you'll see that when interest rates are high, people spend less money overall, which is worse for the economy and tends to affect the stock market in a negative way. Also, these other safer types of investments that I was mentioning before, their returns tend to become a little bit more attractive because they tend to give you a higher return than they used to, whereas the stock market is giving you a lower return. So that will tend to cause people to pull their money out of the stock market, which is falling, and into these safer type of investments. And in the world right now, interest rates are so low. They're lower than they've been for a really long time. And so that's one of the reasons why the stock market is doing really well despite all the craziness going on in the world right now. And the second factor that affects the stock market in general is global events. Think geographic events, political events, things like wars, trade wars, terrorism, natural disasters, pandemics. Didn't have to add that one on the list until recently. And all of these events create uncertainty, instability, and tend to affect the stock market negatively. The effect of these events on the stock market tends to be much more pronounced for negative events than positive events. And that means that you'll see a much more severe negative reaction in the stock market for a major negative global event then you will see a positive effect on the stock market for a positive global event. And the event doesn't even have to be happening at all. Just the threat that a negative global event could happen is enough to send the stock market into a downward spiral. And the third factor that affects the stock market in general is the printing of money. So who's responsible for printing money? In Canada, it's the Bank of Canada, and in the US, it's the US Federal Reserve. And they have the power to literally inject money into the economy when necessary. And this has happened a lot during COVID to prevent the entire collapse of the stock market. Think of your US stimulus check that you've gotten during the lockdown. When money is injected into the economy, it makes people more likely to spend money and it increases the cost of goods. And all of that is generally a good thing for the economy, which in turn is a good thing for the stock market, which will cause stocks to go up. And this is another reason why, despite the disaster that's going on in the world with the pandemic, the stock market is having its best days because so much money has been injected into the economy to prevent the market from collapsing. And the fourth factor that affects the stock market in general is investor confidence. Now, this is a big one, regardless of what's happening with interest rates and money printing and whether there's a natural disaster. Human psychology plays a big role in the stock market, and it always will. Now, what makes investors really confident is certainty and knowing what's going to happen. Uncertain times are very bad for the stock market. And I think if you look at the market crashes in history, the biggest market crashes have been due to an unexpected and shocking event that was bad. So when it comes to COVID, in February, when COVID was announced as a pandemic, everybody was shocked. We were all just living our lives and we got smacked across the forehead with this novel virus, and it literally shut the world down. Nobody was predicting it. You could not have expected it. These types of shocking, unexpected bad events are generally what will cause the most sudden and severe crashes in the stock market. Now, the tricky thing about them is they're unexpected, and so it's very hard to predict these downturns. On the positive side though, any unexpected good news generally will have the opposite effect and will have a very sudden positive effect on the stock market. And with the pandemic, we didn't know when a vaccine would be coming. Some people were saying maybe late 2021, possibly 2022. It takes a long time to develop vaccines. And recently we learned that the vaccine may be available and ready for distribution by early 2021. Now that was shocking, unexpected, and it was good news, and good news for a very large number of people around the world. And that caused a sudden increase in the stock market relatively quickly because it really increased certainty about what's going to happen. Once we have a vaccine, the world can get back to normal to how it once was, and that increases confidence for investors and makes people more likely to want to put their money into the stock market. So when you think of investor confidence, think of certainty. Certainty is really good for the stock market, and uncertainty is really bad for the stock market. So those are all factors that affect the market in general, but what affects individual stocks? Pretty simply, it comes down to fundamentals, and that means how is the business doing? The stock that you are investing in, what's going on with that business? And in order to know how a business is doing, you have to look at the quarterly report. Any stock you're thinking of investing in, if you Google that stock's name and you go to their page, they will have a tab called Investor Relations. And under that tab, you will see the quarterly reports. Now, it gets a little bit grainy because in order to be able to assess these reports, you need to be able to read and understand a balance sheet. But very simply, how a business is doing is going to be directly related to their stock price, and it's going to have the biggest effect on whether their stock goes up or down. So these are things contained in the quarterly report, things like earnings per share, cash flow, debt to equity ratio, all of these technical indicators that show the health of a company. And if these indicators are good and sales are rising quarter over quarter and year after year, and the company is continuing to make more money and growing, then the stock price will rise. And if the opposite is true, then the stock price will go down. Now, it's not only important about what's happening with the stock today, but expectations of what's possible for this company in the future are often included in the stock price today. So a great example of this is Tesla. A lot of people will argue that Tesla is completely overvalued today based on its profit to earnings or P/E ratio, which is much higher than most other growth companies. But other people will argue that the price of Tesla is what it is today because the expectations that Tesla is going to do great things in the future is already baked into the stock price today. So it's important to know that not only the sales and the numbers of the company today are related to the stock price, but also the expectations of what that company will do in the future. So if you've made it to the end of this video, you should be able to answer the question, why are stocks reaching all-time highs despite everything going on in the world right now with the pandemic? We have low interest rates. We have money being injected into the economy like we have not seen in a long time. And we have really good news now with the vaccine on its way. We know more about this virus than we did back in February, and that has increased certainty overall. And all of these things together have contributed to the bounce back in the market that we have seen since the sell-off back in March and April. Remember, every extreme negative reaction in the stock market tends to be an overreaction. And the worst thing you can possibly do during these times, like back in March and April, is panic sell. The best thing you can do is stay invested if you're invested. If you have extra cash on the side, that is the time to buy. Things are on sale. Don't panic, stay invested, and you will do really well. Thank you guys so much for watching. Like this video and subscribe if you are new, and I will see you guys in the next one. Bye.